And our last do is a very, very fast one. It is batch. And batching means not buying a stock at once. For example, I have decided, I have made the decision, I'm getting into this company. I'm buying. I want to buy this company. I've decided, and I've also decided how much I want to buy, $100,000. Now, as an investor that isn't a trader, I don't really know how to time the market. I don't really know if tomorrow it's going to be 2 or 3% bigger or 2 or 3% lower of a valuation. I just think, long term, 5 years forward, I think it's going to be 300% bigger, or 300% higher the stock price. That's why I decided to invest in it. But I don't see the little movements in the market, and I don't know how to calculate them. This is why you use batching. And batching means that if I decided I want to invest $100,000 in this company, I will not go over to my trading app or trading service of choice and just write, I want to buy Apple for $100,000 at the current price. I'm going to decide that I will buy it over 5 days, for example. And I'm going to take these 5 days, 2, 3, 4, 5, unless there's some earning call between them and I don't want to mess up my buying. So let's say this is a week where something shouldn't be happening. And each day I'm going to buy twice. I'm going to buy 2 hours after the market opens and 5 hours after the market opens each day. And we have now 5 times 2, so that's 10 different buying points. So let's divide 100,000 by 10. Also, we don't have to do it exactly the same amount each time, but generally that's how we'll do it. And it's $5,000, or $10,000, $10,000, $10,000, $10,000 invested into the company, gradually getting into your position of the investment. And this will protect you from something like this happening. This is the company, you're thinking this is it 5 years in the future, this is it 5 years in the past, I want to buy here. This protects you from something like this. So you were right in buying. You looked forward and you were correct. So your decision to buy was correct. But if you had batched instead of buying at a horrible moment, which you couldn't have possibly predicted, then you would have bought some here, some here, some here, some here, some here, here, and here. And then this would be your average, much lower. And now this can also mean the opposite sometimes. This can also mean the company might do this, and you made a mistake by buying. But it basically takes the risk of sharp movements and lowers it. So if you're making a mistake, it's a smaller one. If you're making a great decision of buying right now, as in terms of not in 5 days, then it's a little worse, but it's still good. So this just takes down the volatility of your of the next few days after you bought, and evens out your average buy point in the week that you are buying. So this is also something useful when you're making very large positions. You'll see most companies do this, investment companies. For example, if Berkshire Hathaway, for example, decides to invest in a company, they're not going to say, hey, here's $30 million on this company, or $2 billion. They're going to say, yeah, we've started looking at this company. Yes, we started investing, and we've grown our position, and they'll slowly add more and more money as long as there's still things that are still looking intact. But they're not going to throw a big pile of money on a company at once. And this brings us to our last don't. And this is very, very important. Do not, under any circumstances, panic. This will bring you to bad decisions. And this, when I think of this rule of do not panic, it reminds me of this video. This guy says, so I started getting traded in the stock market, and so I bought this stock because I thought it was going to go up. And it started going down, so I sold it all. And then I thought, and then it started going up again, so I bought more of it. But then it started going down, so I sold it all. Now, you can see where this is going. This guy is making mistakes by acting on the graph, by acting on small movements and by acting on the past instead of the future. So his first buying decision was a correct one. He said, I want to buy the stock. Let's say this is a year later. 1 year later. And he was correct. And let's say this is it, by the way. So he was also correct long term. And then it started going down. So what did he start to do? Panic. So he sold it. And it started going up. Now, maybe he was also right in selling it, but he started to panic. He started to have a fear of missing out. So he bought it. Started going down. He sold it. He's making decisions based on the past, not the future. And the only decision he made on the future was his only correct one. He was correct to buy the stock because long term it went up. He was wrong to sell the stock because it was at a low point. He was wrong to buy it unless you're thinking very future goals, because he was only going to sell it a couple of days or even a couple of minutes later if you're more into trading. And this generally means that when you invest in a company, this is, by the way, a pretty bad example. It's more of a joke, this video, and this is not by any means any scientific graph that I'm showing you. But this means when I make a decision, when I invest in a company and I've researched it for half a year and I decide to invest $10,000, I did my batching, I got into it. And this is a big position, for example, $10,000. I'm worried to lose this money. And then the next day, this company's stock tanks from 100 all the way down to 40. Now, this does not mean that I was wrong in my decision to buy it. I was thinking 5 years in the future, how the revenue is going to grow, how this was going to get there, and then they had a horrible earnings or a horrible statement from the company. Panicking would be saying I was wrong. Let's sell. Just because you were wrong to buy it here doesn't mean it would be correct to sell it here. That would be a panic sell. And this would be a panic buy if it started going up. And you bought it because it's going up. You want to buy when people are selling and you want to sell when people are buying. That is generally how big money gets made in the stock market. And that is the opposite of panicking. That is acting cool when the market is panicking, and panicking when the market is acting cool. And you should never panic, even when the market is acting cool. That was kind of a twist on Warren Buffett's great saying. But generally, do not make decisions based on the past or very sharp turns. Make them thinking of the future. For example, I bought the stock at $50 and it went down to 20. Now my dad told me we should sell it. We lost money. I told him, yeah, that's in the past. Right now I'm looking at this stock. It's worth $20. It's being sold for $20, and I think it's worth $30. So I think we should sell. When it goes to 30, he said, but we lost money. Let's sell. Let's get out of this. Let's not lose more. That would be panicking. That would be acting on recent events. The fact that it went down does not mean it will go down more, and the fact that it went up will not mean it will go up more, and vice versa, by the way. Stocks don't always rebound or go back down. That is it for today. I hope I didn't burn your brain too much. I hope I brought you great education and great content that you also enjoyed. I'm Dan from Happy Trading, and have fun time trading. Be safe.